Welcome back to Mortgage Markets and More. I'm your host, Peter D'Angelo. Happy Friday, everybody. What a week it's been. Very excited to share with you the update after the Fed rate cut announcement on Wednesday. And then we're going to look at what's going on in an initial market reaction as of recording this podcast on Thursday morning. And I will say, burying the lead here, there's going to be more to cover probably next week about market reaction. So today we're going to talk more about what happened this week and what that will mean as we move forward, particularly for first-time homebuyers, anyone looking to sell, or anyone looking to refinance their mortgages. Let's start off with the Fed rate cut announcement. Came out the gate pretty strong. They came out with a 0.5% cut. So right now, the Fed fund rate is 4.75 to 5%. It's always within that 0.25% range. And it was at 5.25% to 5.5%. The reason for this larger cut was in large part due to the fact that we saw unemployment tick up rather quickly over 7 months. And pairing that with the fact that most inflation reports are showing really meaningful progress down to the 2% target that is the Fed Reserve's bank's target for interest rates. So with all that said, there was some commentary after the rate cut announcement, and then some questions were answered by Fed Chair Jerome Powell. In a nutshell, this was one of those special meetings where all 19 members actually put down on paper where they see their monetary policy going over the next 6 to 12 months. Particular attention is being paid to from now until year end. There was a consensus. There was one dissenting Fed member, which is the first time in a while, that did not vote for the 50 basis point or 0.5% cut. There was otherwise consensus, and that Fed member believed that a 0.25% cut was appropriate. So that being said, all Fed members pretty much have an expectation of continued cuts between now and year end. That's good. That means that inflation's coming down, but also signals that there's some concerns about the labor market, because as we talked about in the past, labor market unemployment's going up, and we're also seeing that there's less job openings actually available when there was the downward revision by the Bureau of Labor and Statistics. Now, with consideration of that, they're going to stay data dependent moving forward, even though they plot it out, and they're expecting probably another 0.5% less on the Fed fund rate if we just aggregate all the consensus. Some people think more, some people think a little bit less. There's 19 members on this Federal Reserve Board, so reining all that together, just about another 0.5%. There's 2 meetings left in the year. There's a meeting November 6th and 7th, which is very close to the election. I'll get into that in a second. And then December 17th and 18th. The November meeting is a little bit tricky because there's going to have to be meaningful, strong data that would support a cut, because the Federal Reserve needs to be considerate of the optics of it being a politically motivated move, being that close to an election. So we're likely going to see how these inflation reports are published between now and the next meeting. And we have the whole month of October. There's no meeting in October. So the market is going to make their reactions based upon what Fed Chair Jerome Powell had mentioned as where their head is at. The markets are aware of the Fed's head right now. They know what they're thinking. They have a good sense of what their move is going to be. And what that will translate to is eventually lower interest rates. And I know there was a 0.5% cut, and it doesn't make sense. You're probably thinking, why are the interest rates not coming down right now? It's a great question. And the reason that the interest rates are not coming down right now, right after the Fed made their announcement of a rate cut, is primarily because the markets were already expecting it and trading in a way that was expecting this rate cut. Now, they weren't sure if it was 0.25% or 0.5%. And sure, the fact that it came out at 0.5%, that's great. But the market doesn't just look at this one. When I say the market, I mean the people who are trading stocks in the equities market, people who are buying and selling bonds in the bond market, which affects the yield on the bonds. And those are the things that drive the lending rates. So the Fed, you can think of as like Fed Chair Jerome Powell makes their policy announcement, establishes the Fed fund rate, domino effect downward into the actual markets where they start trading in a way that then starts to affect where interest rates are. So it's not just a one direct relationship to Fed fund rate, mortgage rates, or credit card rates. It's Fed fund rate, what the implications are for the market, how the markets trade, and now what we look at for interest rates. So all that in consideration right now, we are seeing that the markets are still expecting probably another 75 basis points, otherwise 0.25%, or maybe even a whole percent cut by the year end. The Fed chair and other Fed members created their dot plots, which they put pen to paper. And like I said, they expect probably another 0.5% by year end. So there's a little bit of dissonance between that and what we're seeing with the actual market and what people are expecting. So let's look at where things are as of recording this episode on Thursday, early morning, going through the bond market and where mortgage rates are currently. So the 10-year Treasury bond yield is at 3.65%. The 5-year U.S. Treasury bond yield is at 3.47%. And the 2-year is at 3.6%. So the 10-year, 5-year, 2-year, up a little bit. You still have a little bit of an inversion, but the 5-year is a little bit lower, quite a bit lower than the 10-year. So we're flattening out that yield curve. That's going to have implications for adjustable rate mortgages, which we'll get into when we look at the mortgage rates. But overall, pretty much the same as last week right now. And it's going to be status quo. It takes time for the markets to digest a Fed announcement, and they will overanalyze everything, every word, every response to reported questions that Fed Chair Jerome Powell made, and then they're going to start trading accordingly. Looking at the mortgage rates, again, according to Mortgage News Daily survey of a multitude of different banks across the country, the 30-year average fixed rate mortgage is 6.15%. I wish it were 3. The 30-year FHA is at 5.7%. The 30-year jumbo is at 6.4%. The 15-year fixed rate is at 5.65%. And the 7/6 SOFR ARM is at 6.15%. It's the only one that made a little bit of progress from last week. Everything else is pretty flat. Expect that to be flat because of what I mentioned earlier. We're not going to see anything until trading starts changing in the markets that affect the mortgage rates. So for right now, we have status quo. I thought it would be a really fun exercise to set up a scenario for you because now with all the conversation about rates going down and what that could mean for housing inventory, the number of homes available to buy, and what that means for people who are running into affordability issues, let's actually look at the numbers. And what I did for this scenario today, I'm going to lay out just some of the parameters. I picked a random home in Totowa, New Jersey, where I live and work. And in New Jersey, inventory is still tight. So I picked a random home, and I created a scenario of what it would have looked like being purchased in January of 2020, what the interest rate looked like, making assumptions that between January and now, September of 2024, what the home value would look like, plus what it would look like maybe 6 months from now with A, a likely lower rate environment, and B, a likely appreciated home. Because as I've talked about in the past ad nauseum, I am a firm believer that as rates go down, home values will go up. Barbara Corcoran also mentioned this too. I trust her judgment. She knows what she's talking about on the real estate side, and I fully subscribe to that because as affordability is created by lower rates, you're going to have people who can be more competitive. Rates going from where it was 7% just a couple months ago down to this average now of 6.15% is huge. That could be $50,000 to $75,000 more buying power for the same monthly payment with just that change in the interest rate. So we're going to use this scenario kind of to make a case for anyone who's on the fence about selling their home. And the reason why I'm doing this is because I think it's very important that, look, you look at the interest rates, you feel, oh my goodness, my monthly payment is going to double. Oh my goodness, it's going to be so much more expensive now for me to buy a new home. I need to upsize. I need to downsize. It's going to just be more expensive. We're going to go through these numbers, and I'm being very picky and choosy about how I'm creating this information in this scenario because it is very conservative in the outlook. So let's get right into it, right? Let's say we've got this property. I cherry-picked out of Totowa, New Jersey, in a desirable neighborhood, well-conditioned home. I think a 3-bedroom, 2.5 bath with a half-finished basement, and it had a value, and where value came from for this was Quantarium Core Logic, and Real Estimate, all on Realtor.com. It's 3 lines. They do have a wide variety based on how their metrics work. I average them together. So we're kind of just getting an average of what these estimated values were. So back in January 2020, home value was in the range of $410,000. We're assuming, let's say, home buyers put 5% down. That is $20,500. Loan amount is $389,500. The interest rate at that time was 3.4% on average. I know what you're thinking. Oh, but what if they refinance, got 3% or 2.875? I'm not including that for these reasons. Number one, when you refinance, you recast your mortgage. And that means that more of your monthly payment goes toward interest, less toward principal. So the balance is going to be higher in that scenario. That means there's going to be less equity. So like I said, this is conservative, giving them more equity. Number two is also that most people, when they refinance, their home values went up. So that meant they could roll in their closing costs into their loan, which means they didn't come out of pocket with those costs and their loan balance went up. So again, this is a conservative approach, just keeping 3.4%. And I'm going to also include here in this monthly payment, before I share it, mortgage insurance. Mortgage insurance is required when you put less than 20% down. So let's say they had a mortgage insurance amount of 120. It's decent credit. Excellent credit would be lower. Let's just say decent credit. So $120 for the mortgage insurance, and the loan with an interest rate of 3.4% would have a monthly payment of $1,727 a month. So all in, it's $1,848 a month, $1,848 a month for that home that was purchased January 2020 at a value of $410. Now let's fast forward. September right now, I took a look at what those data providers' analysis of value is, and then I averaged it, and then I added 4% because I'm setting up the scenario for like 6 months from now. And I'm making assumptions. I'm making assumptions that the interest rates are going to be lower. I have around 5.25%, 5.25% is my example. I think that's possibly attainable. If things continue to go the way that they're going. 6 months may be a little optimistic, but let's just say 6 months. And like I said, if interest rates go down, property values go up. So I added an extra 4% on value for 2 properties. The property that this scenario home seller would be selling and the property they could be possibly purchasing, which I cherry-picked a home currently for sale in Totowa in a highly desirable neighborhood with an extra bedroom, extra bathroom, more space. That property would be, with a 4% factor added onto it, around $670,000. But the home seller's property would have a value probably somewhere in the range of $618,000, $620,000. So we're going to say $618,000, and if we take out their closing costs as a seller, paying realtor commissions and other things, and using a very conservative factor for that, they probably have about $219,000 worth of equity in this scenario from the home that they purchased in 2020. The new home is $670,000, factoring in the 4% appreciation. If they just shift that equity, all of it, $219,000 over to the new home as down payment, that's 33%. No mortgage insurance required now. That's $120 savings immediately. Secondly, they're moving $219,000 over on a $670,000 purchase. $451,000 would be that loan amount. And the interest rate, like I said, assuming 5.25%, would translate to $2,490 a month. These numbers, all of them, do not include taxes or homeowners insurance, but I just want to compare apples with apples because those things could vary. And obviously, if you're buying a larger home, there's an implication for taxes, so bear that in mind. But we're just looking at the mortgages here. So when we compare one to the other, $2,490 a month versus $1,847 a month, $1,848 a month, it's a difference of around $643 a month. And that's a 34% increase. It's nothing to shake a stick at. And I do not mean to downplay an increase like that. But this is an upsized scenario. This is a bigger home. This is maybe there's a family need that would, need to be met by this. Okay, so it's a larger home. You're paying appropriately more for it. If we were to have the same rate environment, just to compare, one of the flaws in doing this exercise is if the rates were the same in January 2020 as they are now, the home value appreciation component wouldn't be there. We would have had very likely a more normal market for the past few years. But just for illustrating the point, your monthly payment would have gone up 9%. It would have been like $2,100 a month if you were to just compare the same rate on the new property. So what's the point here? The point is selling your home and upsizing, which is probably your quote worst case scenario, right? You know you're going to have to spend more money. It's $643 more a month, 34% increase on your monthly payment. That's not double what your mortgage payment is. That's not 50% more than what your current mortgage payment is. It's 34% more. When you have a 3.4% interest rate and you see 5.25%, the likely reaction is like, oh man, my mortgage payment's going to double now. It's going to be so much more expensive. It is more expensive. Like I said, not downplaying that, but it's not double and it's not even 50% more. So it's really worth considering that when interest rates go down, it's going to make more sense for people to make that next home purchase, which I hope will start opening up more inventory because there is an incredibly high pent-up demand from home buyers, particularly in my state of New Jersey and in the tri-state area, but and other parts of the country are still kind of reaching a more normal, quote-unquote, real estate inventory level with homes being listed for sale and negotiations happening. That's still not really happening here. This is a best and final situation in North Jersey and the New York tri-state area. So more inventory will help that. I chose the upside scenario also because in a downside scenario, these numbers just get better because you have more equity and you're buying a smaller home. And the value of that home will comparatively be less than the home that you're selling. So even with a 5.25% interest rate, if you need to downsize, your monthly payment may still go up, but it may only go up 10%, 15%, which is, again, not double, and it's not 50% more than what you're currently paying. I hope you found this scenario helpful and useful. Next week, I am fairly confident I will have the National Association of Realtors information for the sales data, so we can take a look at that. Look at what's the state of things from the real estate side as we head into the fall. But if you have any questions or anything you'd like to hear covered on the show, please reach out, like, share, subscribe. You can DM me, you can text, call, email, all of the things. Reach out. I would love to hear from you. And if there's anything that would help you, I want to make sure that I cover that and present that for you. But until next time, have an amazing weekend and take good care.